Picture this. It's a Tuesday morning, you're sitting at your desk and you get a call. Your car just broke down. The mechanic says it's going to be $1,200 to fix, and your stomach just drops. Not because $1,200 is some life-altering amount of money, but because you're sitting there doing the mental math of which bill you're going to delay, which credit card has enough room, whether you can ask your parents again without feeling like a complete failure. And the worst part? You have a job. You make decent money, but somehow, some way, you are one car repair away from a genuine financial crisis. If that scenario felt a little too real, stick around, because today I'm going to show you exactly how I built a 6-month emergency fund on a $45,000 salary, and more importantly, why most people who try to build one completely fail, not because they don't have the money, but because they're approaching it in a way that works against how their brain actually functions. My name is John, and I spend way too much time thinking about the psychology of saving money. If you're someone who knows they should have an emergency fund but can't seem to make it actually happen, or you've started one 17 times and keep rating it every few months, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Let's get into it. So here's the thing. When most people talk about emergency funds, they reduce it to arithmetic. They say, just save 3 to 6 months of expenses. And they say it like it's the easiest thing in the world, like you just hadn't thought of that, like the reason you don't have an emergency fund is because no one told you to save money. That advice is technically correct and almost completely useless, and I want to explain why. The Federal Reserve does a report every year called the Report on the Economic Well-Being of U.S. Households. In their most recent data, they found that roughly 37% of Americans couldn't cover an unexpected $400 expense without borrowing money or selling something. Not $4,000, not $40,000, $400. And the median household income in the United States right now is sitting around $74,000. So we are talking about people who make decent money being completely financially exposed to a minor inconvenience. That's not a math problem, that's a psychology problem. And until we address the psychology, the math doesn't matter. Now, here's what I want you to understand before we get into the actual strategy. Building an emergency fund on $45,000 a year, which breaks down to about $3,750 a month before taxes, or roughly $2,900 to $3,100 take-home, depending on your state and situation, is genuinely achievable. But it requires thinking about this completely differently than you've been taught to think about it. Let me show you the actual numbers first so we have a foundation, and then we're going to get into the stuff that actually makes this work. If you're making $45,000 a year, let's say your take-home is $3,000 a month. That's a clean, easy number to work with. Now, a 6-month emergency fund is based on your monthly expenses, not your monthly income. This is a distinction that most people miss, and it matters a lot. So let's say your monthly expenses look something like this. Rent or mortgage, $1,100, car payment, $300, car insurance, $120, groceries, $350, utilities, $150, phone bill, $80, subscriptions and miscellaneous, $100. That puts you at about $2,200 in monthly fixed and semi-fixed expenses. 6 months of that is $13,200. Now I want you to sit with that number for a second. $13,200. For a lot of people on a $45,000 salary, that feels like a mountain. It feels distant. It feels like something that maybe happens in your 30s or 40s if you're lucky. And this is exactly where most people give up before they even start. But here's what I want you to think about. That's 340 days, less than a year. If you save $1,100 a month, you're there in 12 months. And I know what you're thinking. $1,100 a month on a $45K salary? That's insane. That's almost 40% of my take-home. There's no way. And you're right. Probably not $1,100 a month. But what if I told you the number doesn't matter as much as the system? And what if I told you the goal isn't even to get to $13,200 as fast as possible? That the obsession with hitting the full number is actually one of the things that destroys people's momentum and causes them to quit. Here's what most people don't realize. The emergency fund is not a savings goal. It's an identity shift. And the moment you start treating it like a destination instead of a practice, you've already lost. Let me tell you about where I was a few years ago.
I was making almost exactly $45,000. I had a decent job, I was responsible enough, I paid my bills on time, but I had maybe $400 in savings at any given moment, because every time I got close to having a cushion, something happened. Not even always a real emergency. Sometimes it was a concert, sometimes it was a flight deal. Sometimes it was just a rough month where I convinced myself I deserved to treat myself because I'd been working really hard. Sound familiar? I had tried 3 different times to build an emergency fund using the traditional method, which is look at your budget, identify your surplus, transfer the surplus to savings. And it never worked. Not because the math was wrong, but because the approach ignored everything about how I actually behaved with money. The breakthrough for me came when I stopped thinking about saving as something that required willpower and started thinking about it as something that required architecture. I needed to build a system where saving happened automatically, where the money was accessible enough that I didn't feel trapped, but inconvenient enough that I didn't casually spend it, and where I could see progress in a way that actually felt motivating instead of demoralizing. Let me break that down into what it actually looked like in practice. The first thing I did was what I call the emergency fund audit. And this is not a budget. I want to be really clear about that, because I know a lot of people's eyes glaze over the second someone says, make a budget. This is different. The emergency fund audit has one purpose: to find your real monthly expenses, not what you think you spend, not what you hope you spend, what you actually spend. Go back through your bank statements and credit card statements for the last 3 months and categorize every transaction, every single one. When I did it, I discovered I was spending $340 a month on food outside my grocery budget. Not restaurants, not going out, just random stuff. A coffee here, a gas station snack there. DoorDash at 11 p.m. because I didn't want to cook. $340 a month that was just bleeding out of my account in $8 and $12 increments that I never noticed because they were individually small. That's $4,080 a year, by the way, almost a third of a 6-month emergency fund, gone on stuff I genuinely could not remember buying. Now, look, I'm not going to tell you to stop getting coffee. That's not the point of this exercise. The point is that most people are operating on financial assumptions that are months or years out of date. You think you spend $200 a month on food outside the house because that's what you budgeted 2 years ago when you set up a spreadsheet you never looked at again. But life changes, habits change, subscription prices go up, and your actual spending has drifted far from what you assume it is. So step 1 is just knowing your real number, not to judge yourself for it, just to see it clearly.
Once I had my real number, I did something that sounds almost stupidly simple, but genuinely changed everything. I opened a separate savings account at a completely different bank from my checking account. Not a savings account at the same bank where your checking is, a different bank entirely. And here's why this matters on a psychological level. When your savings account is at the same bank as your checking account, transferring money out of savings takes about 4 seconds. You log in, you click transfer, and the money's back in your checking within hours. There's basically no friction whatsoever. And friction, it turns out, is incredibly important when it comes to not spending money you're trying to save. When I moved my emergency fund to a high-yield savings account at a separate online bank, I won't name specific banks because these things change, but look for FDIC-insured high-yield savings accounts. You can currently find rates between 4% and 5% as of recent. Suddenly, getting that money required logging into a separate app, initiating a transfer, and waiting 2 to 3 business days for it to show up in my checking account. That wait time is everything. Because here's how most impulse financial decisions work. You see something, you want it, you justify it, you buy it. The whole process takes about 11 seconds. But when you have to wait 3 days for money to arrive, the impulse is usually faded by the time the money shows up. You've had time to actually think about whether you need it. You've interrupted the pattern. A 2021 study from the National Bureau of Economic Research found that individuals who experienced even minimal friction in accessing savings were significantly more likely to maintain their balances over time compared to those with instant access. The inconvenience isn't a bug, it's the entire feature. Now, within that account, I set up what I call tiered visibility. I'll explain that in a second, but first I want to address something because I can already hear a certain objection forming. Now, you might be thinking, okay, but what if there's a real emergency? What if my car breaks down and I need that money right now and it's going to take 3 days to get there? This is a legitimate concern, and it has a legitimate answer. You keep a small buffer in your regular checking account. I call it the buffer fund, and it's separate from the emergency fund conceptually. It's about $500 to $1,000 that just lives in your checking account and you never touch it. It's your immediate access cushion for things that can't wait. For anything bigger than that, 3 days is almost always enough time. Very few true emergencies require you to have $3,000 available in the next 6 hours. And if you're thinking, but John, I don't have $500 to leave sitting in my checking account as a buffer, stay with me because I'm going to show you how to find that money. This is where it gets really interesting because this is the part most financial advice completely skips over. The traditional advice is to automate your savings. Set up an automatic transfer on payday and don't touch it. And that's fine advice, but it assumes something that isn't true for a lot of people on a $45,000 salary, which is that you have a clean, predictable surplus every month that you can consistently remove from circulation without it causing problems. When you're living closer to the margin, some months you have surplus and some months you absolutely do not. And if you set up a fixed automatic transfer and you're having a rough month, one of two things happens. Either the transfer goes through and you overdraft, which costs you fees and destroys your momentum, or you cancel the automatic transfer to avoid the overdraft, feel like a failure, and somehow the automatic transfer never gets reinstated. What I did instead was something I call percentage first saving. Instead of automating a fixed dollar amount, I automated a percentage of every single paycheck, no matter what, even if it was a short paycheck, even if it was a weird week. On a $45,000 salary paid bi-weekly, your gross paycheck is about $1,730. Let's say take-home is around $1,350 after taxes and deductions. I started with just 5%. That's $67.50 per paycheck, $135 a month. Not impressive on paper, I know. Bear with me. At that rate, it takes about 8 years to build a full 6-month emergency fund. Obviously, that's not the plan. But here's what actually happens when you do this consistently for the first 60 days. It stops feeling like losing money. Your brain recalibrates to your new effective take-home. You stop seeing that money as money you have, and that's the foundation for everything that comes next. Because here's the trap that most people fall into when they try to save aggressively from the start. They set a too high a target, they feel the pain of reduced spending immediately, they have one hard month where they need the money back, they pull it out, they feel like a failure, and they stop. Then 6 months later, they try again with fresh motivation and the same result. Starting at 5% is not a long-term strategy, it's a proof of concept. You're proving to yourself that money can leave your account automatically and life continues. That's all you're doing in the first 60 days. After 60 days at 5%, I bumped it to 8%. Then 90 days later, I bumped it to 10%. Not because some rule said I had to, but because by that point, I genuinely couldn't feel the 5% anymore. My lifestyle had adjusted without me having to use any willpower. So adding another 3% wasn't starting over from zero. It was building on a foundation I'd already built. This is called the savings escalation method, and it's backed by some really interesting behavioral economics research. Shlomo Benartzi and Richard Thaler, two economists who've done extensive work on retirement savings, found that when people agreed to automatically increase their savings rate every time they received a raise or at regular intervals, their savings rates climbed dramatically higher than those who tried to set a high rate from the beginning. The study was focused on retirement savings, but the psychological principle applies exactly to emergency fund building. The reason it works is that we adapt to our circumstances. Humans are incredibly good at adjusting their spending to match whatever money is available. This is actually what causes lifestyle inflation. Your income goes up and your spending expands to fill the space. But you can use that same tendency in the other direction. Remove money before you can adapt to having it, and you adapt to not having it instead. Then remove a little more, and you adapt again. By the time I was saving 15% of my take-home, which is about $450 a month on that $3,000 take-home, it genuinely did not feel like $450. It felt like nothing, because my baseline had already adjusted 3 times. My $3,000 felt like $2,700, then $2,550, then $2,400.
but my lifestyle had calibrated at each step, so nothing felt deprived. $450 a month gets you to that $13,200 six-month emergency fund in just under 30 months, 2.5 years on $45,000 a year with no side income and no dramatic lifestyle changes. Now I want to show you how to accelerate this, because 30 months is fine, but there are some moves that can get you there faster without making you miserable. Here's what most people don't realize about the windfalls they receive throughout the year. Tax refunds, annual bonuses, birthday money, cash gifts, selling stuff you don't use. The average American tax refund is around $3,100 according to IRS data, and most people spend it, not because they're irresponsible, but because when a lump sum shows up, it feels like the same money as regular income. It feels like found money. It feels like it's available to spend on something. I made a rule. Every windfall, I mean every single one, went entirely to the emergency fund until it was complete. Tax refund in April, emergency fund. Got $200 cash for my birthday, emergency fund. Sold my old laptop, emergency fund. Worked an extra weekend and made $180 in overtime, emergency fund. In my first full year of doing this, I had $540 in automated monthly savings. I was at about 18% by month 12, and I received a $2,400 tax refund and sold about $600 worth of stuff I'd been meaning to sell anyway through an online marketplace. That's $6,480 in the first year between automated savings and windfalls, almost exactly halfway to my 6-month goal in 1 year. The second year, same system, but higher automation rate, similar windfalls, and I crossed the finish line about 14 months into year 2. 18 months total, not 30, and I never once felt like I was living on the edge of deprivation. Now I want to show you how to accelerate this, because 30 months is fine, but there are some moves that can get you there faster without making you miserable. Here's what most people don't realize about the windfalls they receive throughout the year. Tax refunds, annual bonuses, birthday money, cash gifts, selling stuff you don't use. The average American tax refund is around $3,100 according to IRS data, and most people spend it, not because they're irresponsible, but because when a lump sum shows up, it feels like the same money as regular income. It feels like found money. It feels like it's available to spend on something. I made a rule. Every windfall, I mean every single one, went entirely to the emergency fund until it was complete. Tax refund in April, emergency fund. Got $200 cash for my birthday, emergency fund. Sold my old laptop, emergency fund. Worked an extra weekend and made $180 in overtime, emergency fund. In my first full year of doing this, I had $540 in automated monthly savings. I was at about 18% by month 12, and I received a $2,400 tax refund and sold about $600 worth of stuff I'd been meaning to sell anyway through an online marketplace. That's $6,480 in the first year between automated savings and windfalls, almost exactly halfway to my 6-month goal in 1 year. The second year, same system, but higher automation rate, similar windfalls, and I crossed the finish line about 14 months into year 2. 18 months total, not 30, and I never once felt like I was living on the edge of deprivation. Now I want to show you how to accelerate this, because 30 months is fine, but there are some moves that can get you there faster without making you miserable. Here's what most people don't realize about the windfalls they receive throughout the year. Tax refunds, annual bonuses, birthday money, cash gifts.
There's another layer to this that I want to get into because it's something I never hear discussed, the guilt loop. When people raid their emergency fund for a non-emergency, they usually feel guilty, and guilt, counterintuitively, often makes saving behavior worse, not better. Here's why. When you feel guilty about a financial decision, your brain wants to escape the discomfort of that guilt. And one way it escapes is by just not thinking about it, not looking at the balance, not engaging with the budget, not opening the app. Because looking at the evidence of your failure feels bad, and your brain is very good at avoiding things that feel bad. This is why financial shame is such a significant obstacle to financial progress. It's not just uncomfortable, it actively causes disengagement from the very behaviors that would help you recover.
A 2019 study published in the Journal of Consumer Research found that financial shame correlated strongly with avoidance behaviors, including reduced financial planning activity and lower likelihood of seeking financial information or advice. The antidote to this is not to pretend the withdrawal didn't happen. It's to normalize recovery. If you pull $500 from your emergency fund for something that wasn't an emergency, you don't restart from zero mentally. You just note the current balance, you restart the automated deposits, you maybe add a small extra contribution for the next couple of months, and you move forward without drama. Recovery is part of the system. It's built in. You didn't fail the system, you're using the system. Let me talk about the specific timeline I used because I think concrete milestones matter a lot for maintaining motivation over a process that takes 18 to 30 months. Month 1 through 2. Set up the separate account at a different bank. Automate 5% of every paycheck. Do the 3-month spending audit and get an accurate picture of your real monthly expenses. Calculate your actual 6-month number. Month 3 and 4. Bump savings rate to 8%. Open a second, smaller savings account for non-emergency but irregular expenses. Things like annual subscriptions, holiday spending, car maintenance that's not an emergency. Contribute maybe $50 to $75 a month to that account separately so you have a release valve for spending that isn't on your emergency fund. Month 5 through 8. If you've hit 60 days without touching the emergency fund, you've broken the initial hump. Bump savings rate to 10% or 12% if you can do it without genuine hardship. Redirect any windfall money entirely to emergency fund. Month 9 through 12. Reassess your expenses. Any subscriptions you can cancel, any bills you can negotiate down. I called my internet provider and negotiated my bill down $25 a month just by asking. That's $300 a year, applied directly to emergency fund. Bump savings rate to 15% if possible. Month 12 to 18 or beyond. Maintain the system. Stay consistent with windfalls. Don't add to your lifestyle until the emergency fund is complete. This is the hardest stretch because the initial excitement has worn off, but you're not at the finish line yet. This is where a lot of people drift. My solution for the middle stretch was a visual tracker, an actual physical piece of paper on my fridge that showed progress toward the goal, like a thermometer filling up. Sounds cheesy, works incredibly well. There's good research from behavioral economics on the importance of visible progress indicators. It's related to what's called the endowed progress effect, where people are more motivated to complete a task when they can see they've already made meaningful headway. I want to address the people who are thinking, this all sounds great, John, but I genuinely do not have any surplus. My expenses equal or exceed my income every single month. What then? This is a real situation, and I want to take it seriously rather than gloss over it. If you're truly at zero surplus, the emergency fund equation has 2 variables, the amount you save and the amount you spend. If you can't increase the savings variable, you have to address the expense side, and this requires a different conversation than the one we've been having. The fastest places to find emergency fund money when there is no obvious surplus are usually the following. Housing is typically the biggest expense and also the hardest to change quickly, so let's set that aside. But the second and third biggest expenses for most people are transportation and food. On transportation, if you have a car payment, understanding whether refinancing is an option could save you $50 to $100 a month depending on your original loan terms and current rates. If you're paying for a level of car insurance above your actual risk tolerance, there may be room to adjust coverage on an older vehicle. I'm not saying do anything reckless with insurance. I'm saying verify your coverage actually matches your situation. On food, the difference between someone who spends $250 a month on groceries and someone who spends $500 a month with the same household size is almost entirely planning. Not couponing or extreme frugality, just planning, knowing what you're going to make before you go to the store, buying protein in bulk when it's on sale, making more at home. These aren't dramatic sacrifices, they're just habits that take 3 to 4 weeks to build.
On subscriptions and recurring charges, the average American is paying for somewhere between 3 and 7 subscriptions they either forgot about or use less than once a month, according to research from subscription management services. Go through your bank statement from the last 60 days and circle every recurring charge. Be honest with yourself about which ones you'd miss and which ones you'd forget about in a week. Cancel the ones in the second category. That's probably $40 to $100 a month for most people. And on income, I know everyone says just make more money like that's easy, but there are some things that are actually actionable in the short term. Selling unused items in your home, one-time or occasional gig work, negotiating your current salary. A 2023 survey by Salary.com found that 84% of employers expected employees to negotiate salary, but most employees didn't. If you haven't had that conversation in the last 18 months, it might be worth having. The point is that I have no surplus is often a real constraint, but it's worth doing the full audit before accepting it as a permanent state. Let me talk about the interest on your emergency fund for a minute, because I think this is an underappreciated factor. If you're keeping your emergency fund in a regular savings account at a big national bank, you're earning 0.01 to 0.10% interest. On $13,200, that's $1.32 to $13.20 per year, essentially nothing. But if you move that money to a high-yield savings account, and as I mentioned earlier, rates have been meaningfully high in recent years, you're looking at 4 to 5% on $13,200. That's $528 to $660 per year in interest, passively, for having money sitting in a slightly different account. Over the time it takes you to build the full emergency fund, that difference compounds into something meaningful. And psychologically, seeing interest credited to your emergency fund account every month feels good in a way that reinforces the behavior of maintaining the balance. Now, I know some people ask, should I invest the emergency fund instead of saving it to get better returns? And I want to address this clearly. No, the emergency fund is not an investment vehicle. It has one job: to be there when you need it, in full, immediately accessible, without market risk. If your emergency fund is in stocks and the market drops 30% in the same month your company announces layoffs, which is exactly the kind of thing that happens in economic downturns, you've just had your emergency fund cut by 30% at the worst possible moment. High-yield savings is the right vehicle. Accept the lower return in exchange for certainty and accessibility. Here's something I want to spend a few minutes on because I think it's the most psychologically important part of this entire conversation. Why does having an emergency fund change your life beyond just covering emergencies? Because here's the thing, financial stress isn't just stressful in the moment, it impairs your cognitive function on an ongoing basis. A landmark 2013 study published in Science, conducted by researchers including Sendhil Mullainathan and Eldar Shafir, found that the cognitive burden of financial scarcity was equivalent to losing roughly 13 IQ points. Not metaphorically, functionally. People under significant financial stress performed worse on cognitive tests at a level comparable to operating while sleep-deprived. Think about what that means for your life. If you're constantly running the background calculation of whether you can cover an unexpected expense, and a significant portion of Americans are doing this all the time, that mental load is quietly consuming cognitive resources that would otherwise go toward your work, your relationships, your creative thinking, your decision-making. You are not operating at full capacity, and you probably don't even know it because this is just what normal feels like. Having that 6-month buffer doesn't just protect you from financial catastrophe, it literally frees up mental bandwidth that you can redirect toward everything else you're trying to build. People who successfully build an emergency fund consistently report, and this is something I heard over and over in conversations about this, that they feel more capable at work, less reactive in their relationships, and more willing to take calculated risks in their career or business because the floor has risen. The worst-case scenario has changed. When you know you can survive 6 months of no income, a lot of things that seemed risky start to look like opportunities. That's not a small thing. That's a life-altering shift in how you experience and navigate the world.
I remember the day my emergency fund crossed $10,000. I was sitting at the same desk where 18 months ago I'd gotten that call about my car, and I got a